Have you ever wondered how to start investing with little money? It's a question many of us have pondered, and it's time to debunk a common myth. Investing doesn't require a massive pile of cash. In fact, the journey to financial growth often begins with small, steady steps. Investing, in its simplest form, is about making your money work for you. It's about placing your hard-earned dollars in places where they can grow, multiply, and create a secure future for you. You don't need to be a millionaire to start. You just need a little bit of money, a dash of patience, and a pinch of knowledge. Remember, every towering oak tree started as a small acorn. Similarly, your financial growth can start small, and over time turn into a wealth of abundance. The key is to start. You don't need a fortune to start investing, just the right information and a willingness to learn. So, what are the types of investments you can start with? Well, there's a wide array of options you can dip your toes into. Let's begin with stocks. Buying stocks essentially means owning a piece of a company. As the company grows, so does your investment. Stocks are a great way to grow wealth, but they can be volatile, meaning their value can dramatically rise or fall. Then, there's bonds. When you purchase a bond, you're essentially lending money to a company or government for a certain period. In return, they agree to pay you interest on the money you've lent them. Bonds are often seen as safer than stocks, but the returns are typically lower. Next up, we have mutual funds. A mutual fund is a pool of funds collected from many investors, which is then used to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds are managed by professional fund managers, making it a good choice for beginners who may not yet feel comfortable picking individual stocks or bonds. Exchange-traded funds, or ETFs, are similar to mutual funds, but are traded on exchanges, much like individual stocks. ETFs offer the diversification of mutual funds with the flexibility of stocks, and can be a cost-effective way to diversify your portfolio. Lastly, there's real estate. This is a tangible asset that you can physically see and touch. Investing in real estate can involve buying rental properties or flipping houses. It can provide steady cash flow and potential tax benefits, but it also requires more effort and capital compared to other types of investments. Each of these investment types comes with its own risk and return profiles, and suitability for beginners can vary. For instance, stocks might be suitable for those who can tolerate higher risk for potential higher returns, while bonds might be more suitable for those who prefer stability. Mutual funds and ETFs can provide a balanced portfolio for beginners, while real estate might be more suited for those who have more capital and time to invest. As a beginner, it's essential to understand these investment types to make informed decisions. Before you dive into investing, have you set your financial goals? Imagine you're setting out on a journey, but without a destination in mind. Without a clear goal, you might wander aimlessly, and your efforts might lead to less than satisfying results. The same logic applies to investing. Your financial goals serve as your destination, guiding your investment decisions and helping you track your progress. Think about what you want to achieve financially. Is it early retirement, buying your dream home, funding your child's college education, or perhaps just building a safety net for unexpected life events? Once you have identified your goals, you can start to align your investments accordingly. For instance, if you're aiming for early retirement, you might want to consider long-term investments that compound over time. Or if you're saving for a short-term goal like a vacation, safer investments might be more suitable. Remember, investing isn't a one-size-fits-all strategy. Your goals will shape your investment approach. Having clear financial goals will keep you focused and motivated on your investment journey. Every investment comes with its risk and return. But what does that mean? Well, let's break it down. In the world of investing, risk refers to the possibility that you might lose some or all of the money you've invested. It's the uncertainty that looms over the outcome of your investment. On the flip side, return is the money you stand to gain from your investment. It could be in the form of interest, dividends, or an increase in the value of the asset you've invested in. Now here's where it gets interesting. Risk and return are directly proportional. This means that generally, the higher the potential return, the higher the risk. Think of it like a seesaw. When one side goes up, the other goes down. So if you're eyeing an investment with potentially high returns, be prepared to stomach a higher level of risk. But don't be discouraged. This doesn't mean you should shy away from risk. Instead, it's about understanding and managing it. One effective way to do this is through diversification. This is the practice of spreading your investments across various assets or asset types to reduce risk. Imagine your investment portfolio is a basket. If you put all your eggs in one basket and the basket falls, you lose all your eggs. But if you spread your eggs across different baskets, even if one falls, you still have eggs in the other baskets. This is essentially what diversification does. It helps cushion the blow if one or more of your investments don't pan out as expected. But remember, while diversification can help manage risk, it doesn't eliminate it. There's always a certain level of risk involved in investing, no matter how diversified your portfolio is. The key is to find a balance between risk and return that aligns with your financial goals and risk tolerance. In conclusion, understanding the relationship between risk and return is an integral part of investing. It's not about avoiding risk, but rather managing it effectively to maximize your potential returns. Understanding risk and return is crucial in making sound investment decisions. Now that you're equipped with some basic knowledge, how do you actually start investing? Well, the first step is research. This is an essential part of the process. You have to understand the market, the different types of investments, and the potential risks and returns. Get a good grasp of investment terminologies and concepts. This will help you make informed decisions. There are numerous resources available online, from articles to video tutorials, that can help you with this. Next, you have to choose the right investment platform. There are a plethora of platforms out there, each with its own unique features. Some are more user-friendly, some offer a wider range of investment options, and others may have lower fees. You need to find the one that fits your needs and comfort level. Remember, starting small is not a disadvantage. It's a smart approach, especially for beginners. You don't need a huge amount of capital to start investing. You can start with what you have, and gradually increase your investment as you gain more confidence and experience. This approach also allows you to diversify your investments, spreading your risk across different assets. Once you've started investing, it's essential to monitor your investments regularly. Keep an eye on how they're performing. Are they meeting your expectations? If not, it might be time to reevaluate and make some adjustments. But remember, investing is a long-term game. Short-term fluctuations are normal and shouldn't cause panic. Also, it's important to keep learning. The world of investing is vast and constantly changing. Staying informed and up to date with market trends and news will help you make better investment decisions. Participate in investment forums, attend webinars, read books, and follow reputable financial news sources. The more you know, the better equipped you'll be to navigate the investing landscape. Investing is not a one-time event, but a continuous process. Stay informed and keep learning. Remember, every investor started somewhere, and with patience and diligence, you too can build a strong investment portfolio. Why should you invest, especially when you have little money? This question often crosses the minds of many, and today we're going to delve into the answers. Investing isn't just for the wealthy. It's a powerful tool that can help anyone, regardless of their financial situation, to grow their wealth over time. When you invest, you're putting your money to work for you. Instead of letting your hard-earned cash sit idle, you're giving it the chance to multiply. And the exciting part? Even small amounts can grow significantly over the years thanks to the magic of compounding. Think of compounding as a snowball effect. Your initial investment generates returns, and these returns are reinvested to generate their own returns. Over time, this process can turn a small snowball into a massive snowmound. But wealth accumulation isn't the only benefit of investing. It can also serve as a source of income. Certain investments, like dividend-paying stocks or bonds, can provide you with a steady stream of income. This income can supplement your regular earnings or serve as a safety net during uncertain times. Another compelling reason to invest is to beat inflation. Inflation is like a silent thief, slowly eating away at the value of your money. By investing, you're aiming to get a return that's higher than the rate of inflation, preserving the purchasing power of your money. And let's not forget about the sense of financial security that investing can bring. With a well-diversified investment portfolio, you're not solely dependent on your day job for income. You have your investments working for you, providing you with a financial cushion and the freedom to make choices that align with your life goals. Investing, even with little money, can set you on the path to financial freedom. So, are you ready to start your investment journey? Remember, the journey of 1,000 miles begins with a single step, and that step could be as simple as making your first small investment.